Welcome to the Accounting Profits and Prosperity Show. I'm your host, Louis Prosperity. Our guest is an acclaimed speaker and author on the topic of value pricing, one of my favorite topics. Hi, Mark. Welcome to the show.
It's great to be here. Thanks for inviting me.
It's a pleasure, Mark. I'm really excited to talk to you today because you're one of the foremost leaders in what I call proactive strategies for accounting and bookkeeping companies. What I also like about what you do is you also take a holistic approach, even though we talk about value pricing, which is the cornerstone, but you talk about other aspects of the business. What I'd like to do is if a person really wants to get into value pricing, what is the strategy that they should begin? Like, where should they begin on the strategy side? Because I'm a strategist at heart.
Okay, interesting question. Where should they start? I think a lot of it, to be honest, is mindset. I think there's a big mindset issue. I think about my experience when I ran my accounting firm many, many years ago. I started it in 96, and I grew up in the accounting profession believing that you had to keep timesheets and that you had to log hours and you had to bill based on the hour. So that's how I was brought up in the profession. And I think many of us are. And so in our hearts, we've got this affection for timesheets for some reason and believing that we have to log hours and keep track of costs and stuff. And so value pricing is quite a big mindset shift. And that's, I think, what has to happen first.
So let's talk a little bit about mind shift, because I do agree with you. I think if you don't do the mind shift, how can you actually implement the strategy? What components allow someone to do the mind shift? What do they have to unlearn or relearn when it comes to that mind shift?
Yeah, it's an interesting one. That the first thing I kind of touched on it is we have to get away from this timesheet mentality about logging hours, and we have to recognize that when we're value pricing, we are pricing based on the value to the customer, which in itself creates a big problem because value itself is subjective. You can't touch it, you can't feel it, you can't measure it. How do you place a value on, for example, doing a bookkeeping project or doing a tax return? That's the challenge we have to overcome. But nevertheless, that's a starting point. We have to recognize that we're pricing based on value. And that means, and this is something that people find sometimes a bit challenging, is that means costs are irrelevant. How long something takes is irrelevant when we're value pricing. And that's, I think, the big hurdle that we have to get over. But at the end of the day, whenever there's a transaction taking place, there has to be there's an exchange of value and both parties have to make a profit on the deal. The client will have in their mind some sort of perception of value, and they have to see the value being greater than the price. And the accountant, the bookkeeper, has to see the price being greater than costs. So yes, we want to make a profit on the deal, otherwise we won't do the work, but we don't use cost as the basis of coming up with price.
You know how when you learn how to ride a bike, you have training wheels, right? I think your system has training wheels set in. Could you talk a little bit about your training wheels and how to get someone who is so used to having a hourly mentality to slowly go over to the other side?
When I came across value pricing, and it was late 1999, and I first came across Ron Baker, I was introduced to Ron Baker by my good friend Paul Dunn. And it was late 99 when I was running my sole practitioner accounting firm when Ron explained this concept of value pricing. And for me, this light bulb went on immediately. And I think it was because my background, I'd always been into economics, never really understood the practical applications of economics. I did it at university as a degree, I did it at school. And then Ron, I know you know Ron comes very much from, he looks at the theory first and then how to apply it. And the way he described it in his first book that he published over 2 decades ago now, it just made so much sense to me. I thought that's a much better way of pricing. And it was great timing because I had been wrestling with how can I possibly give, particularly potential new clients who I'd never met before, how can I give them a price up front, which I knew they wanted, but without knowing how long it would take, how many hours was necessary, I had no idea. And then this light bulb went on and it made sense to me. And then a few years later, I sold my accounting firm to my client managers. And I started then, I was running a business with Steve Pike, teaching accountants in the UK how to run more successful businesses before I set up the Value Pricing Academy. And I think the mistake I made in the early years of teaching value pricing is I was teaching people how to move from time-based billing, the timesheets, to moving to value pricing. And some people like me just got it and made the shift and made it work. But the vast majority struggled and failed. And I realized about a decade ago that for most people, it's a difficult shift to make because of the fact that value is subjective. You can't touch it, you can't feel it, you can't measure it. And as a profession, we like to measure everything. We're numbers people. And so I realized that you have to teach it in steps and build one step at a time. And the first thing that I teach people to do who are pricing based on the hour, the first thing I teach people to do is how to give a fixed price up front. And I know you know this, Luke, as we probably talked about before. Fixed pricing is not value pricing. Fixed pricing is still a form of cost plus pricing, but it's a necessary step we have to go through in our evolution of moving towards value pricing.
So what you're saying is step one is fix your price. Get used to having a fixed price rather than a, what we call, whatever, how long it takes price, right? Because when you charge by the hour, it has nothing to do with, like you said, the output. And at one time, that wasn't bad when you were all manually based systems. Now with automation and everything, in fact, if we continued using that process, we'd be charging less and less for the same service and having to do more and more work.
Absolutely.
So by fixing your price, you're literally changing that. You're moving closer to value because the price is fixed and it's not, you're disengaging the hours, which I like. What are some of the techniques when you determine, because they're going to ask you, okay, fixed price. Have you heard this one before, particularly for bookkeeping services? I don't know, Mark, you might have heard this one, where what we'll do is we'll go and do 3 months based on the hours, and then we'll give you a fixed price. Because what happens is they don't know what they don't know. How's a way to avoid, to rather than doing that 3-month investigatory process, how do you get to fixed right away? Like, what do you use?
I don't see a huge problem when people are learning this process of doing some initial work as a diagnostic. I teach bookkeepers quite a lot about how to price cleanup work, which I think is even more of a challenge. And one of the things that we talk about is that you want to do a diagnostic review, but you do charge for that up front. You charge for doing the diagnostic review. So you gather enough information to then come up with the price. And I guess from a bookkeeping point of view, you could still do that. You could have some sort of way of doing some initial work to gather the information. But you asked the question, how could you give the fixed price right up front? And remember, of course, that fixed pricing is not value pricing, it's cost plus pricing. But it's a great place to start, because when we're value pricing, then most of the time, not always necessarily, but most of the time we are giving a price up front. I say not all the time because there are other value pricing models where it doesn't involve a price being known at the outset. And we could talk about those, and some of them are applicable to the profession and some aren't. Like, for example, auctions. Nobody knows what the price is until the bidding's finished. But it's a classic value pricing model, auctions are, because the person that pays the highest price is the person that pays that because they value it more than anybody else. But the price isn't known until afterwards, till it's finished. So, and that's where I think people sometimes get confused, that if you're value pricing, you don't necessarily give a fixed price up front. But let's talk about then fixed pricing. If we are fixed pricing, then it's still cost plus pricing, because the only difference with fixed pricing compared to time-based billing is time-based billing, we wait till we finish the work, we add up the hours, and then we surprise the client with an unexpected bill. At least with fixed pricing, we're fairer to the customer, giving them a fixed price up front, and we do that based on our best guess at how many hours we think it might take. That's why it's still cost plus pricing. But at least it's fairer on the customer because they get a price up front. And it's better for the accountant, the bookkeeper as well, because when they price up front, they can get paid up front, which is really, really important. We should never, ever do accounts receivable. That's crazy. It kills our cash flow. So how do you do it? Well, you've got to start off by figuring out how many hours or what do you think the costs will be? And so you need to have a system that enables you to accurately predict how much it's going to take and how long a job takes. So we're talking about bookkeeping. It all depends on the scope factors. And so I teach that with any accounting service, there are different scope factors, things that impact on how much work's involved. And given that bookkeeping is largely data entry, probably the most important scope factor, I call it the primary scope factor. The thing that's the most important is probably how many transactions are there. The more transactions, the more the price will need to be to cover that. But there are other scope factors as well, which I call the secondary scope factors, which are things like how many bank accounts. If they've got more bank accounts, there's more bank reconciliations. How many credit card accounts? Are they registered for sales tax? And so on and so forth. There are many other factors. And what we need to do is do some analysis based on our experience, based on our existing client base, to try and figure out, so how much should we charge for a client that might have, let's say, 100 transactions every single month? How much
Right.
if they had 10,000 transactions? And we can do that. We can do that using what I call regression analysis. Sounds complicated, but essentially Excel does all the heavy lifting and does all the calculations. So what I did, if I just take you back to 1999 when I came across value pricing, I was an accountant, not a bookkeeper, so my core service was end of year financial statements. And I wanted to give people a price up front. So what I did is I looked at a random sample of 10 of my existing clients. I put on an Excel spreadsheet for each of them what was the fee I was charging, or should charge if I was charging correctly, and what was the most important factor. In that case, it's the size of the business. For accounting firms, it's typically the size of the business. What's their annual revenue? And I just plotted that on a graph, and Excel will give you a graph which gives you a formula that you can use as a starting point. It's not a perfect formula because you then want to factor in the secondary scope factors. You might want to adjust it for a few things. But bottom line is this, Louis, because fixed pricing is still a form of cost plus pricing, it is possible to come up with a formula that you can use to come up with a price. We're not value pricing yet, but once we've got that formula, once we've got that framework, we can then get started on the journey of once we've given people a fixed price. And I think that's the hardest part of the whole journey. Moving from, if you're wedded on the timesheets, you're always billing based on hours. The most scary thing is how can I give somebody a price up front when I might make a loss on it? It might end up being more work than is necessary. That's the hardest step. Once you can do that, once you've got a way of doing that, actually moving to value pricing is not so difficult. There's lots of little steps along the way still, but that's the hardest part.
Well, to me, the way what you've explained to me right now is, I get cost plus, but there is a finite component, because once you achieve the fixed price, the hours no longer matter. So once you come up with the price, the actual time that it takes to do the work is now disengaged, right? So am I right on that? The way you described it is, yes, the fixed price is determined based on what we estimate will be the time, right? But once the fixed price is in place, that's it. We're done. No longer tracking time. Correct?
Yeah, let me give you an example, a practical example, a fairly recent example from my perspective. Because you're right, once you've agreed the price, then if you can build in internal efficiencies that make, by investing in software, for example, that makes your life easier to get the end result, then you as the bookkeeper benefit from that, because we're not billing based on time. If you can do it faster, then you're benefiting from your own innovations, systems, processes. So if I talk about my bookkeeper for my own business, I've had a bookkeeper for many years. She's great at what she does. I've always been happy. They happen to be a bookkeeping business that tends to specialize more in zero. I use QBO. And when we agreed the price for doing it, I said to her right at the outset, I said, look, if you want to build in some automations to automate hooking up my Stripe account to QBO so it automates the posting and stuff, that would be great from my point of view. For some reason, she never did. And then one day she reached out about a year or so ago and said, Mark, your transactions have gone up a huge amount and I'm going to have to bill you more. And I said to her, yeah, but you're doing things very manually. Why don't you put some of these integrations in place and automate the whole process? Now, she didn't know how to do it, so I reached out to one of my Value Pricing Academy members who happens to be an expert at this sort of stuff, and I hired her to put in the automations. And now my bookkeeper's really happy because the price that I was paying her all along now was a profitable price. As a customer, I wasn't expecting her to reduce her price because I'm getting the same result as I was before. In my mind, I was just thinking, why didn't she think of that in the first place? Because I was happy paying the price, the monthly price to her for a certain outcome. And I don't care how she does it. If she'd have just gone ahead and put those integrations in place on day one and saved her a ton of time, great, good luck to her. And that's, I think, sorry, go on, Louis.
Oh, no, sorry, because that just triggered something for me, and I'm going to ask you another question, was exactly, so value pricing or fixed fee pricing, if you go fixed fee pricing, it almost incentivizes you compared to hourly pricing, right, to look for what you just talked about, right? Now, you're a very kind customer. You showed her how to do it, but she was based on the hourly manual system. And all she could figure out is, okay, your volume went up, I got to charge you more, but the value to you never changed. Correct. So I love that. So I really like the fact that the fixed pricing so talk about the mindset change. Now, when you have a fixed price, the incentive is for the professional to become better at their job or to utilize tools better. And how do you do that?
So just repeat the question again, because I wasn't sure I fully understood it, Louis.
So when you did the fixed pricing, right?
Yeah.
Now all of a sudden you have become better at doing it, and the manual components, there was no incentive for you to utilize technology until you fixed price, right?
Yes.
So now you've done the mind change to fixed price. How do you then incorporate the technology to get you to the next step?
Oh, in terms of value pricing.
Yeah.
Yeah. So I always think when I started discovering value pricing in 1999, the first thing that I implemented was what I call menu pricing. So menu pricing is when you come up with three different choices. Think of it as the bronze, silver, gold. And I remember the very first time I applied that in my accounting firm to one of my services. It happened to be a tax service. I increased over the next 2 years my average price by over threefold.
Yes.
And there's reasons for that. I didn't know why at the time, but now I do, because it's so powerful. It works. And I always describe menu pricing, giving the client three choices, as the first step towards towards value pricing. And so, and here's the reason why. So I teach something called optimal pricing, how to get the best possible price. And every customer has what economists call a buyer's reservation price, which we can think of as the maximum willingness to pay. We all have a maximum that we're willing to pay for anything. We don't necessarily know as customers exactly what that number is. Sometimes it's subconscious, it's a feeling. But I bought, for example, an iPhone last year, the iPhone 12 or 13. I've lost track of the numbers. Right. In Portugal, it was about 1,200 euros. They're pretty expensive compared to the US, for example. Had it been 2,000, that would have been above my max. I would not have bought one for 2,000. My maximum is somewhere close to that. I don't know exactly what the number is, but possibly I might have gone to 1,300, probably not much more than that. Apple are brilliant at trying to figure out what's the maximum people are willing to pay. So we have this maximum willingness to pay as a customer, but there's also what economists call the supplier's reservation price, which is basically the minimum price as a supplier that we would want to charge. And so the way I teach it is that the fixed price that you might come up with, becomes your minimum price. That's the base price that you'll never go below. But when we start to apply value pricing, we're now building on that. We're now getting a better price. And what we want to do is recognize that here's our base price, our supplier's reservation price. This is the customer's maximum willingness to pay. The price has to be somewhere between those 2 points, because we both have to make a profit on the deal. The problem is, as accountants and bookkeepers, we are worried about people saying that's too expensive. So when we give a price up front, we give a price hoping the client will say yes. And usually we go in way too cheap. And therefore we leave all this money on the table. The client would have happily paid more, but we were worried about that reaction. Our goal is, if that's the client's reservation price, we want to get our price as close to that as possible, because even if we charge that price, the client is still making a profit, because that's their maximum willingness to pay, because in their mind there's further value on top. So we want to get as close as possible there as possible. So how do we do that? How do we set a price as close to that as possible? And we can't say to the client, what's the maximum you're willing to pay for my bookkeeping service? Because they will never answer that question. And if they give you a number, they're lying. It's too low. It'll be a bigger number. So there's no point in asking, and we're not mind readers. So this is where value pricing now comes in. We need to use systems and processes to try and figure out what that price will be. Now, at a more advanced level, what I teach is that when you reveal your price, historically, because we hate that rejection, we hate people saying that's expensive, we usually go in too low. And one of the mindset shifts we have to have is we actually want our first price that we reveal to be above. We want them to say that's crazy expensive. Because only when we've gone too high do we know that we can change something with the client and come down. If we go in too low and the client says, yes, let's sign up. If somebody says yes to your first price, it means you've left money on the table. They would have paid you more money. So let's go back to why menu pricing is a great way to start, the bronze, silver, gold. And let's use, so if we're bookkeeping, we're talking to a particular client, and we've done the scope analysis. We know for that particular client, they've got 100 transactions a month, 3 bank accounts, and we know that we could probably charge, let's say, $1,000 a month for that. Now, when we have the conversation with the client about what we're going to do with their bookkeeping, and then we say, oh, the price will be $1,000. The probability, the chances that 1,000 is exactly where their maximum is so remote and improbable, it'll never happen. That $1,000 will be one of two things: too high or too low. Yeah. If it's too high, we lose out because they don't buy. If it's too low, we get the business, but we've left money on the table. And so a single price is always the wrong price. A single price is the wrong price, guaranteed. It's always going to be wrong. It'll never be right on the money of being the maximum willingness to pay. We'll always be leaving money on the table, or we'll be too high. Sure. So by giving people 3 choices, a bronze, a silver, gold, a basic bookkeeping service, a fuller, more complete bookkeeping, and a premium bookkeeping, now we might say to the client, rather than $1,000, we could say our entry level is $750. Our middle option is $1,000. Our top option is $1,500. Which one do you think is best for you? Right. The client that would have been willing to pay more than $1,000, now they can buy the $1,500 option, and you make more money. If that was too expensive, there's a cheaper option for them. So when we give 3 choices, we make more sales because there's different things for different clients' budgets. And what we also tend to find is that most of our clients also gravitate towards the middle. That's the most common type of client. And we also tend to find there are quite a few premium buyers in our client base. There will always be a certain proportion that will buy the most expensive. And if you don't offer them a premium bookkeeping, they can't pay you that extra money.
I was going to say, if you don't have a premium offering, well, you'll never get a premium customer, right? I mean, I like that idea. I love menu-based systems. I think they're great. I love the fact that the fixed price model that you've introduced is a way to determine your minimum price. That makes sense to me. If you're going to start into the value pricing world, the cost plus is your minimum price, and then you build from there. I think that's great. I think that entire mindset, Mark, is a way to really transition. Go from an hourly price, get to the fixed, use cost plus. And the part that I really talk a little bit about, the investigative thing. How can you monetize that component rather than just going in and saying, let me take a look for 3 months and then I'll tell you? Because if you monetize it and you price that component as an you call it investigation system, that adds even more transparency to the transaction, but it also allows you to provide a better service. No?
Sure, absolutely. And that's one of the key things about value pricing. Sometimes people say to me, isn't value pricing about just coming up with a price, a number? And I would argue that's coming up with a number, the price, is actually a small component of this whole value pricing journey we have to go on.
Right.
A key component of that is we have to be continually thinking about how can we create more value? Because firstly, I think as professionals, our primary focus should always be on the customer and creating as much value as possible. As my friend Steve Pike once said, profits are a consequence. Profits are a consequence of doing the right things. When we do more of the right things, when we create more value for our clients, we'll make more money because they'll pay us bigger fees. So let's focus on the customer first. And one of the things we should always do is ask ourselves the question, what more could we do for this client? How could we solve their problems better? And yes, we might build those into middle and top options and not in the cheapest ones. But for those clients that then value that extra support, they want those extra reports, those extra meetings with you, they will then gladly pay because they're getting more value.
So I love this term. I got this from Ron. It's called plussing. What you're saying right now, when you're saying create as much value as possible, I'm going to call that plussing because I just love that, the word for plussing value. So there's got to be, there must be some methods that you could plus that aren't necessarily you having to learn a brand new trade, right? So what are things that you would consider as plussing value? Like what things that you could add to your top tiered levels as a way to say that this is adding value?
Okay, great question. And I'll give some examples. What bookkeepers should be doing continually is getting feedback from their customers, asking their customers whenever they meet with them, What more could we possibly do to create more value? What challenges are you having right now that you'd like to be solved? We can find out. I mean, I can give lots of examples of what you can do to create more value, but if they're not relevant to what your clients need, they're no good to anybody. So the best people to ask is your clients. What are their challenges? What's their pain points? What would they like you to do that you haven't been doing? But they could be things like helping the client understand their numbers better. So it could be producing more meaningful reports with some colors, some graphs, some analysis. It could be additional meetings to talk about their numbers, talk about their goals in business. We could start to get into the realms of business advisory type stuff. So rather than just looking at the old numbers and creating the numbers, but actually looking to the future and
Right.
helping the client come up with ways of increasing their cash flow, reducing their costs, growing their business, whatever it might well be. So advisory is a huge way that we can add value. And the nice thing about advisory work and creating additional reports, for example, a lot of these added value things create more value than, let's say, the data entry, and therefore can command premium prices, but take a lot less time. The hardest, in terms of the time we spend with clients, it's the crunching of the numbers that's the bit that takes the time. As we start adding more value, clients will pay at higher prices, but it doesn't take much more time to have that extra meeting at the end of the month. It could be a quick Zoom meeting. It could be another great way that I've seen people adding value is they'll get the numbers up to date every month, and then they'll just turn their computer on, their webcam on, go to a tool like Loom and do a quick 5-10 minute video for the client saying, right, here's your profit and loss account. Let me explain some of the things I've seen. I'm a bit worried about this number here. We might want to have a conversation around that. And then they send the video off to the client with commentary. Wow. That's a great way of adding value. And it takes 5-10 minutes to a video and email it across to the client. Firms are doing that and clients love it.
That one alone, to be quite honest, the Loom value alone, I think is great because we are in a digital world, but we are in a visual world, right? The more time for you to possibly do that analysis on a email or a summary could take 5-10 times longer than doing a 2-minute Loom discussion. So I really like that. So Mark, I'm just going to recap. We covered a lot here. I don't know. I know it was only 30 minutes, but what we covered was amazing. We covered how to have the mind shift. I love that. I love the fact that we looked at fixed pricing to determine your minimum price, and then fixed pricing disengages you from the time. And then the other parts was the plusing and the adding the value in the menu-based system. Automatically, if you adopt the menu-based system, you're very close to value pricing, traditional, right? So this was amazing. I really enjoyed this. Thank you so much for your time. Mark, if someone wants to get a hold of you or wants to get to know more about the Value Pricing Academy, how would they be able to get in contact with you?
Okay, great question. So yeah, there's lots of ways to get in touch with me. You can connect on LinkedIn. If you go and find me on LinkedIn, Mark Wickersham, and just do a connection request and say, hi, I'm a bookkeeper. What I always do is whenever an accountant or a bookkeeper connects on LinkedIn, I will then send back connection confirmation with a link to some free stuff. I have a whole bunch of free stuff. Like I did recently, a 28-page report, an ebook on how to price cleanup work. So I'll send back those links via LinkedIn. Another way you can connect with me is I have a Facebook group called Value Pricing with Mark Wickersham. Just request to join the group. And then once you're in the group, you can ask me questions and ask the rest of the community questions about pricing and anything else about how to build a more successful accounting firm. Or you can go to my website, which is www.wickersham.co.uk. I think the first two buttons you see on my website is, are you a bookkeeper? Are you an accountant? If you're a bookkeeper, it'll take you to a page where all sorts of free stuff you can grab. So go to my website, grab my free stuff.
Grab your free stuff. I think your free stuff will be fantastic because it's a great start, but I would recommend them to look at the classes that you offer as well. I've heard a lot about your graduates. I know some of your graduates, and it's fantastic. Again, thank you, Mark. It was a pleasure seeing you again, and thank you for being on the show.
You're welcome, Louis. It's been great to talk to you. Bye for now.
Fantastic. Mark, thanks for being on our show today. Thank you out there for listening and watching. I hope you enjoyed what we had to cover today. I think we've got a pretty good conceptual basis of how to possibly do a mind shift, convert into a fixed price to develop your minimum price, and then go and convert to a full value pricing system. The framework was very well described by Mark, and I hope you guys enjoyed that. Again, please subscribe to our channel. Have a great day, stay hydrated, and be well.